was over the play. So pick up the first down. The penalty was on Antoine Richardson. A little bit more of a breathing room for that 40-yard punt that Penn State. This is a goal line. Here's underneath again to the 40 as he's trapped down. So back to back plays to Harvey.
Crossing routes. Starting on one side, coming across and running away. The idea is get the defender on one edge and front to the other side. Nice throw that time.
That's his fourth catch for 57 receiving yards. He's become Clifford's top target here tonight. A low throw. So as you enter the second half here, you got to think back to a few opportunities that mark it at the 46. Here's Ford. That time.
It's really well done, round down from the inside out. Steve Holman.
Tyler Cullen, local kid out of Baltimore. Always playing. There's another touchdown. Looking for any sort of.
All right. It is time for our class today. And so far, I have not drawn anybody to hear these words of wisdom. So what I'm going to do is I'm going to go through chapter 1 real quickly, because we did that in fairly good detail the last 2 sessions, or at least last Wednesday. Then chapter 2 in pretty good detail. And I think we even had a head start on that. So chapter 3 is not out of the realm of possibility here. So let's see how it goes. I wish there was just one person here, if only to tell me if I'm sharing the screen properly, because nothing makes me look like an idiot more. Well, I'm assuming you can see my slides up here, huh? Here are my slides from chapter 1. And let's go over some of the real basic things we want to talk about, huh? Financing, investing, operating. Just know the 3 types of cash flows: operating, what the business does for a living. Coca-Cola makes soda. General Motors produces cars. They buy raw materials, they buy merchandise, they sell things, they buy things, they pay people, they collect. Those are called operating activities, huh? Operating. That's the operating cash driven by the core of the business. Investing would be purchasing some big equipment, which we're going to depreciate over a longer period of time. Financing is borrowing. So that's all we want to know right now. Our 4 financial statements, and we're really going to cut it down to 3. Income statement, statement of stockholders' equity, and the balance sheet. Hello, you remember this? The accounting equation. The accounting equation. Assets equal liabilities plus stockholders' equity. Stockholders' equity can be called stockholders' capital or just capital. It's the net worth of the business. If this company had $1,000 worth of assets and their liabilities were, say, $200, that $200 is a liability. It is a debt. It is an IOU they have to pay. So the company's not worth $1,000. You have to subtract the debts, the liabilities, to get to the 800 stockholders' equity. Examples of assets, we should be pretty good here. Cash, nice things to have. Liabilities, debts that we owe to our suppliers. Let me qualify that. Accounts payable represents the amount of money we owe at a specific point in time to our suppliers. Notes payable is different. That's money we borrowed. And we looked at a balance sheet. We're going to look at this a little more. The income statement sales minus expenses. You didn't need to come to school to understand that, I don't think. You sell something for $1 and you paid 40 cents for it, you have a profit of 60 cents. Sales minus expenses. I'm going to give the definition again of cost of goods sold, because I know that's still confusing to people. You just need to get it under your head here. Cost of goods sold is simply the amount that we paid for the item we just sold. For the item we just sold. You flash your credit card at Costco and they swipe it. It creates a journal entry where they increase their cash and they increase their sales, and they have to increase the cost of that item. If that item was sold for 1,000 and they paid 300, the cost of goods sold would be 300. So that would go up and the inventory would go down by the cost amount. Here we go. Look at your little grid here on the lower right. You're going to need to be real clear on these different statements. The income statement, I think we're pretty good. Statement of stockholders' equity. Right now, you're looking at just 2 sections, and there'll be more as we go along in the class. Common stock. The common stock line is always the par value multiplied by the outstanding shares. The retained earnings is another component of stockholders' equity. Retained earnings have nothing to do with the common stock. Retained earnings represents the income from the first day of this business throughout its history, accumulating month after month, year after year. So if a company started up, they have no retained earnings. Over the years, they've made $100 million worth of profits. You'd see $100 million there. And that's because we're adding the income to the beginning every month. But if they gave out dividends, that will reduce your retained earnings. And the acronym I like here is BIDE. You got to bide your time. Beginning, income, dividend, ending. It's up to you if you like that kind of stuff. And I'm just going here. We just went over cash flow activities. And I'm not going to show you this other than to highlight basically what we're talking about here. We have a whole chapter coming up on this subject. The balance of cash at the beginning of the year, at the end of last year, was 1.6 and it grew to $10.6 million, okay? That means that the cash increased by 9. Would you agree? 10.6 minus 1.6. Management looks at this thing and they see 87 million positive cash flow from operations. And the boss might say, hey, how come we ended up with only 9? You have to remind the management, don't you forget, we bought that big $125 million factory in London and they borrowed the money. Okay, cash flow. Here, I trust that you've looked at this and you've got these relationships pretty well down pat. Income statement must be done first because we're going to take that net income and we're going to put it into our BIDE mnemonic. We're going to have the I in BIDE. We're going to increase not the common stock, but the retained earnings, and the dividends reduce retained earnings. Once we have that number, we are ready to do the balance sheet. And this is just a matter of copying everything from your trial balance except one number. And what number has changed would be your retained earnings. The capital changed. And then if we wanted to do the cash flow statement, we could. Notes are important in financial statements. Another look at the 4 statements. The 4 statements, know your acronyms, right? GAAP, Generally Accepted Accounting Principles, invented by an Italian monk named Luca Pacioli. And I read his biography, believe it or not. That's what kind of a nerd I am. I ran into that book at a used bookstore. Very good. Notice he invented bookkeeping 2 years after Columbus discovered America. Not a coincidence. Securities and Exchange Act. The Securities and Exchange Commission is the monitor of the New York Stock Exchange and all the public stock exchanges in this country. The New York Stock Exchange is the big one. They have powers to select who can list their stock. And if they let somebody list their stock, they really have to follow these accounting rules as devised by the Financial Accounting Standards Board, otherwise known as FASB. General Accepted Accounting Principles, international, we don't go into that. Ethical conduct, do the right thing. choose the course of action that you would not mind your family and friends seeing you. Don't get yourself in a position where you're making some dubious decisions ethically. It never works out. Ensuring accuracy of financial statements. We'll have more on this, but companies need to protect their assets. Cash, people love to steal cash. Who knew? So one system of control is put the money in a safe. Take the money to the bank every day so there's not a big pile up there. Have different people do different cash activities, etc. The external auditors come in and they audit. It's an examination of the financial statements to make sure they represent what they claim and conform with GAAP. Now, it doesn't necessarily mean that the financial statements are correct. The auditors are not responsible for what is in the financial statements. The person responsible is management. Management's responsible. They provide the information to the auditors who take it in good faith, and the auditors prepare their policies, procedures, and tests as they see fit. And if they pass all these tests, they're able to verify the cash balance, etc. They will say these statements we issue in what's called an unqualified opinion, which is a good opinion that all companies need to have, okay? If they all possibly can, all right? But if management is feeding a bunch of baloney to the auditors, it's not necessarily the auditor's responsibility to catch that. I mean, hopefully they will as they do their task, but if there are multiple people involved, it makes it a little bit harder, huh? You want to do the wrong thing ethically? Look what happened to this company we were just looking at, Lenert. Look at these guys. 20 years in prison, 15, 4.5. They put the wife of the CEO and they put his son into jail. Good gosh. Okay, sole proprietorships. We should know this by now. Sole proprietorships, partnerships, corporation. Remember, the first two, proprietorships and partnerships, have unlimited personal liability. So that was the Nichols tour, if you will, of chapter 1. So let me see if I can get up with chapter 2, which is the main thrust of what we would like to do today. Here we go. Wish me luck. Voila, I hope. Chapter 2. By the way, if these slides are not appearing there, I'm going to be pretty annoyed. But I'll find out when I look at the replay here. Okay, so let me get this. Oops, wrong thing. Let me get this thing nice and big for me and for you. Chapter 2, huh? How do we keep track of things? How do we keep track of things? We're going to do it in folders. If you would, think of a folder inside the computer. Each folder is something that is on your chart of accounts. Cash would have its own folder. So would accounts receivable. So how do we keep track of these things? I am skipping that, huh? Assets equal liabilities plus equity. You get the feeling I repeat that quite a lot? Come on, we got to know that. Assets equal liabilities plus equity. Don't worry about these ridiculously verbose explanations. Assets, we know what an asset is. Something that's of value that we own that can do some productive things for us. Cash is the best asset. Everybody loves cash. Accounts receivable, inventory. All those things can be turned into a profitable transaction. Don't worry about economic resources with probable future benefits owned or controlled by the entity, measured by the historical cost principle. Come on, we don't need that. Here's a balance sheet. This is a good slide to have near you when you're doing your homework online or when you're studying. Notice that they're making a couple points that I want to show you. It's a consolidated balance sheet. What that means, Chipotle might have a separate company they call Chipotle Europe, Chipotle Africa, Chipotle whatever, and everything is just melded together into this consolidation. Notice it says point in time for which the balance sheet was prepared. That's very important to understand. This here is a photograph. It is a snapshot. It is a microsecond point in time. As of the end of business on 12/31/11, This company had $401,200 in the bank. They had invested in other companies, 55, etc. Okay, so you can't say up here month of or for the month ending. That would be wrong. That belongs on the income statement and the statement of equity. This is a snapshot in time, and they're just giving you some different definitions here. External events, that's what this whole class is about until we get to, I guess, chapter 4. We start doing some adjustment. Internal events. There are some journal entries we're going to write, some transactions. The outside world will never even see these or care about them. And they're given kind of a grim example here, a loss due to fire damage. You know, we have to write it, we have to prepare a transaction that recognizes that loss. Here we go. Look at your folders. We're going to call these T accounts or your general ledger. The T accounts are really just a piece of scrap paper, but they mimic the general ledger and thus are very, very useful for organizing numbers and doing some analysis. Here is a nice little grid here. They're breaking out your chart of accounts. Cash, short-term investments, notes receivable. This is your chart of accounts. It goes in order of assets, liabilities, equity, revenues, and expenses. And at the end of each month, we're going to take these revenues, subtract these expenses, and hopefully it's a profit. And we're going to zero out these last two columns and move it into retained earnings, okay? Cash, short-term investments. Here we go. Cash. Think of your chart of accounts as a folder for each item that we are interested in analyzing. It's called double entry accounting for a reason. You must have two accounts in any business transaction, in any business accounting transaction. You must have two accounts, not one, not one. You can have minimum of two, you can have 100. They can both be increasing something, they can both be decreasing something. All right, balancing the accounting equation. Okay, I'm gonna kind of skip here. During the month, what are we doing? We're analyzing things, and when there's a transaction to record, we say to ourselves, what chart of account items are affected? What accounts? What type of accounts? Is this gonna affect assets, liabilities, or equity? And once we know that, is it going up or down? Are we increasing assets? What are we doing? And here, what are the rules for increased responsibility, decreases? Put the number, I'm sorry, I couldn't quite read that. Okay, enter your numbers, will be in balance. So what I'm gonna do is take us through some transactions here. And I did this last week, I believe, just a little bit. So let's go through this chapter 2 here and see if I can make a little bit of sense out of it for you. Chipotle issued 10,000 shares of common stock, 1 cent par value. We have an entire chapter on issuing stock. Par value, we need to know now, is a meaningless, nominal, I said it again, nominal amount arbitrarily set by the state or local government agencies. It has nothing to do with the par value of the stock. But the multiple of the 10,000 shares times 1 penny is $100. And that $100 goes into the common stock part of stockholders' equity. So you have 3 items from your chart of accounts in equity now. You have common stock, which is the $100, and the difference between the cash we received, which was $62,300, that's called additional paid-in capital or added paid-in capital, or we used to call it paid-in capital in excess of par. So look at our cash. We now have 62,000. We have a business going, and we're in balance. They borrowed 2,000 from the bank. I don't know what happened to it. They must have stolen money. I don't see it there. They borrowed $2,000 from the bank. So your cash is going to go up, and a liability account called notes payable better go up as well. Okay, cash went up by 2. And again, we're keeping this equation in balance. They purchased new ovens and various things. They bought $63,100 worth of ovens and equipment. They paid most of it in cash, and they financed the rest with a note. So here we go. Property and equipment goes up. Who knew, huh? Cash goes down, and the note goes up. We reduced our cash by 55. We increased our property and equipment by 63.1. The difference is that note that we used to finance this transaction. So I'm hoping you get the hang of these different movements on the chart of accounts. Chipotle paid $400 to the local bank. They paid back some of that money they borrowed. They didn't pay with any interest. Cash goes down, and so does the note. Before this payment, Chipotle owed $10,000 to a couple of banks, maybe. Now they paid down some of that liability, and of course, cash went down as well. Chipotle had some money lying around, so they went out and they bought stock in another company. They went out and they bought $60,400 worth of Amazon, say. Okay, they intend to hold it for a long time, and that's good. That's of no importance now. It will be later. So let's take a peek here. They paid $60,400 for an investment. 20,900 of it is long-term, and the rest is short-term. Okay, we break it out that way. There'll be another chapter where we're going to talk about if these were bonds, how we would handle those transactions. Okay, let's keep going. Chipotle doesn't pay dividends, but they reinvest profits in the company. Okay, but we're going to pretend that they do. If Chipotle pays a dividend of $3,000, remember our BIDE, stockholders' equity statement, we bide our time, beginning retained earnings plus income minus dividends. So there you see the dividends coming out, and we're going to eventually pay it in cash, but when they announce it, it becomes payable. This could have been a decrease in cash, and it would have the same impact, okay? Some people don't want to get dividends. Companies like IBM, well, maybe IBM is older now, but Microsoft, when it was coming up, Bill Gates said, I'm not giving anybody a dividend. We're going to lose money for a while, but we're plowing every penny back into research and development, and I know we will succeed, and I think he did. So here we go, the accounting cycle. During the month, guess what? We analyze transactions. Here's the payroll report. We look it over. This person worked 10 hours. They make $20 an hour. That's $200, that kind of analysis. You got the phone bill in the mail. You look at the phone bill. You compare it to prior periods, make sure it looks reasonable. You get approval, and then you record it. At month end, during the month, you're doing all these things, analyzing, and then you're recording the transaction, what's called a journal entry, and posting to the general ledger. And the general ledger is just that, general. Inside that general ledger are all those folders we saw that represent the chart of accounts. At the end of the month, we're going to prepare a trial balance and do some adjusting and close out, okay? Say hello to the general ledger and T accounts. T account, like I said, it's just a piece of scrap paper, but it looks like the general ledger. So in this course, we're going to always think of this as being the general ledger unless otherwise notified. So we have the general ledger, which people like to call the books. You've heard that expression. I want to see the books. The books were cooked. The general ledger is the official record of all financial transactions. It shows the transaction. It shows the prior balances. It shows the running balances, and it has references to the other part of the transaction. You look in the general ledger under cash, you'll come up with that folder, that T account, and you'll see it, perhaps credit, meaning a reduction of $400. And then there'll be a little letter next to it, and that's going to be a trail to the other side of that entry. The general ledger is updated when you post Journal entries. Your book likes to call them general journal, huh? Journal entries. So here we go. I hope you have spent some time. I know the class is barely 3 days old, huh? And we started on Wednesday with just a little bit of an intro, and here we are Saturday. Debits and credits. I mean, there's a million ways I could, try to teach this. Experience tells me you just have to keep writing out these journal entries, these T accounts, until they click. You need to know these like the back of your hand, as my Irish mother used to say, huh? A T account, could be any account. The word debit, the word credit. All those two words mean are left and right, nothing else. Left, right, left, right. I guess when this monk invented this system, he could have called it left and right, huh? But the debit side is the left side, credit side is the right side. Neither one of those words, debit or credit, means more or less, increase, decrease, good, bad, up, down. There's no moral judgments here. It's just the rules of debits and credits. Every single account in your chart of accounts has what is called a normal balance. A normal balance. That represents the side of the T account, left or right, debit or credit, which increases the balance. Normal balance is the increase side. So the normal balance for an asset is a debit. You would always expect to see a debit balance in cash. You would never expect to see a credit balance. That would mean you have negative cash, and that indicates a possible problem, right? I mean, you're going to have a lot of credit entries reducing cash, but the balance has to remain a debit. Our accounting equation, assets equal liabilities plus stockholders' equity. So if assets have a debit balance, liabilities and capital would have to have a credit balance. Anything in stockholders' equity has a credit balance. Common stock, credit balance. Additional paid in capital, credit balance. Retained earnings has a normal credit balance, okay? So here's another shortcut to take a peek at it, huh? Assets equal liabilities plus equity. Assets debit, the other two are credit. And eventually, in a few slides here, hopefully we'll see that sales have a credit balance, expenses have a debit balance, and that's really it. It's really just 5 different elements we need to memorize, but it can be grueling and a little confusing. So here we go. Here's our first look at a journal entry. A journal entry. You're going to go into your QuickBooks, into your Mass 90, Oracle. I don't even know what systems they have now these days, but whatever your computer system is, you're going to click on the link that says, bring up the journal entry template. And you're going to go in there and you're going to record that first transaction we saw, the one where Chipotle got $62,300 from the public on a stock issue. You're going to go in here. And when we were doing it 10 minutes ago, we were talking plus minus. Remember, cash went up, cash went down. No more talk like that. We're talking debits and credits now. So here is a journal entry. Very important. Over to the left, you're going to have a date, for certainly a date. Here, you're going to have the account title. Start with the debits. And that's kind of important. Now, when you get working, there might be some real long journal entries coming off a computer or something. Not always can you do all the debits, but when possible. The reason is it's an accounting, it's kind of a ruling. I don't know if it's by FASB or just tradition, but you do have to indent all credits. That's because that's what readers of financial statements expect to see. And it makes it a lot easier for the auditor to look at things more quickly. And it certainly makes it easier for you if you have to go back 6 months from now and look at a journal entry. Here, you immediately see that these two numbers are credits, okay? Debit cash, it went up. Common stock went up with a credit, and so did additional paid in capital because they are both part of stockholders' equity. Look at the T account, okay? We wrote that journal entry. We took this journal entry in our system and we hit post. As soon as we hit post, meaning post to the general ledger, you look in your general ledger now. You look at the folder, general ledger, the chart of account item. You're going to see a beginning balance of 401,200. They're giving us that from last year. We increased the cash with our stock issue, 62.3. That's our ending balance. Common stock, we had an earlier issue, it looks like, but we threw another 100 in there, okay? So you're going to have a beginning balance and a debit side and a credit side. Here, we increased cash. If we spent 62,300, you would have seen it on this side, okay? Looks like they're repeating that for us, huh? Can't look at it enough. Now we're doing those same transactions, at least a few of them. They borrowed money from the bank. Borrowed $200 from a bank, $2,000. Cash, $2,000 debit. Notice the plus sign, it's increasing. Notes payable. Assets have a debit balance, therefore liabilities and equity must have a normal credit balance. So cash is increased with a debit, notes payable with a liability. And here you see it. We started off with 401,000. We added 62. We added another 2. We owed 223.6 at the beginning of this month, and now we borrowed even more money. Now do the remaining transaction yourself. You, okay? Are you done? Okay, I'll give you more time later. You're done. Here is what it looks like when we're done. You prepared all those transactions and you entered them all, and most importantly, you posted them. Now it is the end of the month, and we look at our general ledger, and we see, we have a balance of 349,600 in cash, 94 here. They're showing you the balances. Cash beginning was this. We brought in some money. We brought in a little more than we spent money. I think it's pretty obvious that the higher number is the balance. You just add the 2 columns up and the high man wins, okay? Here, we only have $400 in debits, but we got 233,600 in credits to get us down to that 233.2. So I don't think that's a problem. They call that footing the ending balance. What do we do with these ending balances becomes the question of the day. And here's the answer. We're going to take every one of these balances, that 349.6, that 94.5, the 859, 349.6, the 859, and we're going to lay them out in this report called the trial balance. A trial balance. It's just, again, it's not a report that's going to go out to the public. This is just something we do to organize the data and verify that debits equal credits. If you ever are in the world of accounting, in the month ends, and you find out that the debits don't equal credits, you got something wrong. I also don't think you'll ever run into that mistake. No computer system is going to allow you to post an entry that's out of balance. I just can't believe that could happen. But do I want to say 50 years ago? Geez, more than a few years ago when we did this in pencil, it could go out of balance and it was annoying. Classified balance sheet. All they're doing is separating the assets and liabilities into 2 areas. Assets you have current assets and current liabilities. Current assets are those assets you expect to consume within a year, huh? You're certainly going to be spending cash every day. They told you that this portion here was going to be a short-term investment, meaning they're going to get rid of it in a year. We certainly hope to collect from our customers within a year and use the supplies within a year. Accounts payable. Current. We hope we get paid in less than a year. Anytime you see the word accrued, it's going to be a current asset because you're accruing for a particular month. Notice they have here notes. I'm so sorry, guys. I'm going through this too. Got the happy fingers going here. Notice they have notes payable under other liabilities or long-term liabilities. Notes payable can be either. They can be short-term or long-term, depending on the length. Notice your stockholders' equity is simply the 400 shares they issued, where I guess it was 40,000 for a penny, additional paid in capital, etc. Balance sheet. The balance sheet is a representation of the accounting equation. Okay, we're skipping international ratio analysis. I'm not going to look at that. Cash flows, we're not going to do much with this other than knowing the three different types. Look at this when you're studying, just take a peek at this a few times. Make sure you understand what's an operating activity versus investing or financing. What we're going to learn, I'm going to talk about just briefly. A lot of companies can show profits like crazy, but they're hemorrhaging cash. They're hemorrhaging cash. They're making money, but their debt load is so massive, it's not possible to sustain that business, even though on paper they're making profits. So be very careful when you hear somebody talk about a business. Well, my company is losing money, but we're making great cash flow. Now, the two don't go together very long, okay? End of chapter 2. Wasn't that fun? Now, this was our schedule today, 1 and 2. But I'm going to go into chapter 3 a little bit. And then on, is it Tuesday? I'll come back into chapter 3 with a little more detail, okay? So let me find, I lost the video here. Hold on. We hit that button. Where's chapter 3? Chapter 3. Chapter 3. I need to expand it, huh? Chapter 3, the operating cycle. This is kind of an interesting little bit of GAAP, generally accepted accounting principles. It's a principle that says any business can be broken down into a finite period of time, typically a month, and then report on how the company's doing profit-wise and cash flow-wise. It's called the time period assumption. The long life of a company can be reported into monthly periods. 2 issues when reporting income, huh? When do we report income? When do we recognize issues and measure them, huh? When should we do it? Well, hopefully they're going to start to tell us a little bit here. On the income statement now, as you know, we have revenues minus expenses. Revenues minus expenses give us something we're now going to call operating profit. Operating profit. But you could have other activity that affects your bottom line, and that might be a settlement of a liability, or you lost the lawsuit, or you won a lawsuit, or you got in trouble with, you had to close the division down. One of your stores was not making money, you closed it. These gains and losses have nothing to do with operating, so they come afterward. And we're going to end up with what's called net income. And let's take a little look here. Chipotle, huh? They had sales of 4,108,300. And by the way, that's in thousands, so actually 4 billion. So they sell a lot of food, huh? And what are their expenses? Well, the supplies, that's probably the ingredients for the tacos and salads, wage expense, salary expense, rent, the basic things you would expect to see. Well, we add those up, and they're giving us a category here called general and admin, other expenses, depreciation. And take a look here. These sales minus all of the expenses here gives us an operating profit of 710,800, huh? An operating profit of 710,800. So if you're a potential, if you're a potential investor in this company, I think you'd really be interested in the net income from operations, because this is what the company generated by running their restaurants. It turns out they had some substantial interest revenue, a little bit of interest expense, and subtract that out, you come to net income before taxes. Okay, a brief look at the income statement. Revenues. I am going to ignore these two slides. I think these two slides are just jargon. Examples of operating expenses, utilities, insurance, rent. You could probably think of a dozen more pretty quickly, huh? Other income statement items. Interest revenue, interest expense. They're fortunate enough, this company, to be in a position where they were able to loan money to somebody, and that loan created some interest income. That has nothing to do with operating. That goes below that line. Same thing with interest expense. They borrowed money and they have to pay. If they sell a fixed asset, that's now, well, actually, this one's not right. This one changed a few years ago. We'll skip that. Income tax expense has nothing to do with the operation, okay? International, we're not going to worry about that. How are activities recognized and measured? Cash basis. Notice I skipped right past the cash basis. I'm not going to talk about it. If you're interested, you can talk to me. If you want to learn about it, you can talk to my boss, Cornelia. The reason we don't teach it is that it's not GAAP, and no company of any size who really wants to do things right will use a cash basis system of accounting. If you run yourselves on a cash basis, you will not be able to borrow money. You will not be able to attract investment, maybe even employees, good employees that you might want to hire. They see that, they're going to walk away. Cash basis, you're going to cash basis your way out of business in no time. Accrual accounting, this is what we teach, huh? Accrual. Assets, revenues, everything should be recognized when the transaction that causes them occurs. It has nothing to do with the cash and when it was paid or received. Okay, we sold food today. We're Chipotle's. We got a call from Santa Barbara City College, and they said, can you bring over a couple hundred burritos? We got a big meeting going here. And they bring the burritos over and they hand us a bill. And we're not going to pay that for 30 days. Chipotle must record the sale then and now. You don't wait for the cash. Cash doesn't necessarily follow the revenue. And I think that's a good point. And I don't want to go too far into this, chapter 3, but let's just take a look at this. Cash may be received before you delivered the food. Maybe Chipotle said, no, you got to pay me now, and I'll come back with the food, in a couple of days. So it can come when the food is delivered, it come after, like I just said, or at the same time. At the same time. Same thing when paying things, okay? We pay the electric bill on the day we get it. I mean, that the cash and the expense are the same day, but most likely we're going to pay our bills later. So the cash is going to come out later or before. It has nothing to do with when it happened. It's when it happened. Cash may be received. And I'm just going to go through these a little bit and then we'll call it a day, huh? I have a secret going. I'm watching the Maryland Penn State game. My beloved Nittany Lions, Penn State, are getting murdered. They're 0-3. Back to school. The cash can be received at the same time. Who knew? Debit, cash, credit, sales. I'm going to go through this rapidly because we're going to go over it a little more slowly. But for some of you, I think this might be helpful. For those of you who are still working with chapter 2, that's fine. You're not falling behind. Here's something you haven't seen before. It's called unearned revenue. Unearned revenue. Chipotle sells gift certificates. Chipotle sells gift certificates. When they get that money, they debit cash. But you see that word there? unearned. They haven't earned the money yet. The only thing that happened was somebody walked off the street and handed them $100, basically. And that person walked out with a contract in the form of a gift card. They can buy some food later. That's called an unearned revenue. Unearned revenue. Okay? Cash came in first, revenue later. Cash came in first. And I'm not going to worry about that. Revenue for more complex, I don't think that's of much interest. And what they go into now, they do the same thing with the expenses. First, we just talked about receiving cash. Same thing with expenses. You can have a guy come in and fix the copy machine now, and we pay him. We debit repairs expense and we credit cash. Or we're going to pay the guy later on. Wages payable. This is an accrual account. $400 were worked during the month, but they're not paid yet. We have to accrue that with a debit to wages expense and wages payable. And here's the expanded transaction and analysis model. This is just what we were looking at earlier. And now they're showing a trial balance. So as we get to the transactions here, I think this is a good segue. So we reviewed chapter 1 fairly quickly. We went through chapter 2, I think, in pretty good detail. So that should catch everybody up in terms of the lectures and the expectations as of now. So we got a good start on chapter 3. Don't hesitate to continue with chapter 3. And I think that's going to be it for now. I know everybody wants to watch the football game coming on in about an hour, huh? Who do you like, Clemson or Notre Dame? I think Notre Dame's going to murder Clemson tonight. And then they're going to meet again, and Clemson will have their injured quarterback. It'll be a different story. See you all later. Thank you. You've been a great audience, huh? Bye-bye.